Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Ross Clark with CIBC Wood Gundy in Vancouver, our guest on This Week in Money. Ross has great charts for you, and we're going to tell you how to get them at the end of the podcast. But first, we got to look at the markets, Ross. The week we had this week, what a bad one. Man, the worst day since November, the S&P below its 200-day moving average. Third week of losses for the Dow. Investors obviously focused on earnings, the Eurozone, and something we've been thinking about for quite a while. We're hearing about all day, the fiscal cliff. What are the markets telling us?
Well, the markets, started off the week with just a tremendous update there, going into the election in anticipation of some good news. Clearly, the mandate did not come through as strong as the markets wanted on either side of the coin here. So we've got this big shakeout into Thursday's market, with Friday being a bit of a thrashing around day after that big break. I mean, here we are. We've already, in terms of the S&P 500, we've now given up close to 50% of the gain since the spring low. So,
wow,
fairly dramatic action. Now, I take a look back. I do a lot of work in terms of looking at the seasonal. So we talked about in normal years, you would look for an indication when you moved out of the summer through Labor Day, and how important it was once you broke out that you held the highs. This year, by the time we got into October, we were starting to fail in terms of holding the highs. And now with November taking out the October low, I go to my records and we take a look and find that the breaks of the October low during November become significant because there aren't all that many. I go back 80-odd years and I see that there's 23 years that did this, and you typically would then have, following a break into November, it usually lasts a good 3 or 4 weeks as part of the break, that you'll get a decent bounce back into December. But it's a tough way to start off the, quote, best 6 months of the year, which is usually that November through first part of May stretch.
Russ, once we get away from the external stuff that we're hearing in the media, talk to me about the fundamentals of the market. Where is the market now? Where's it going from here? What does it look like to you?
Well, I mean, you take a look and say, I look at us as being in the secular bear market, and we've had a cyclical bull market. So here we are. We spent 12 years consolidating. We've been top of the range, bottom of the range, which is 50% change in market levels from highs to lows in here. I think if we take a look at the broad picture, you probably have top end. We're sitting just under 1,400 in the S&P right now. You're probably your top end of that range over the next year or two might be as high as 1,600. The bottom end could be back down, through the lows that we saw in June, which would be sort of the typical 10 to call it 12% correct decline off a high. And I would be inclined to think that we will probably go through a bit of a thrashing process more than anything in the next couple of months.
How do I make some sense out of this? Are there any entry points that I should be thinking about?
Well, I think from a market perspective, you clearly anything in particular on the Canadian side these days that has got a good solid dividend. We're still seeing that those issues are remaining very good, very resilient during the phase that we're in right now. Companies that have got good, solid cash flows are doing well, and I think you can be looking to buy those type of things. I would look at 50-day moving averages, 200-day moving averages as the key support areas to be entering into the solid-based companies. The interesting thing that's sitting out there that really is flashing to me is what we saw pretty much all week long as far as this relationship between what was happening on the currencies, the gold market, and the bond market. We had a U.S. dollar that has been rallying for the better part of a couple of weeks here now, broken out through some decent resistance levels. The dollar index trading up over 81 right now, up from a low of 79, and I'm targeting that one to get up to about 82 to 83 is the realistic target. During this last week, not only did we have strength in the dollar index, but we had strength in gold at the same time and the bond market. And this is unusual.
Why is that unusual? Has that happened before, and what's causing it?
Well, there's maybe a 95% inverse correlation between commodity prices, stock markets, and the U.S. dollar index. Because as the dollar goes up in price, anything priced in dollars typically will go down unless there is some driving force to create more value in it to offset the currency move. So it's rather infrequent that you will see these items moving together. And in this case, I think it's this flight that we've seen this week away from equities and into safer havens, let's put it that way, and perceived safety, at least that would be. So when we go back to see previous instances like this, and I've got these in charts that if people want to contact us, they can do that.
Okay.
There are 5 instances that I can point to very directly in the last 2 years that were of importance and become quite definable in terms of how we can participate with them.
We're talking to Ross Clark with CIBC Wood Gundy in Vancouver. And let's take a look at the individual markets themselves. Starting with bonds. Choppy trading in treasuries today, the long end of the curve advancing. And, of course, the fiscal cliff basically concern here. Bond market yields about where they were in August and September. What are you seeing in the bond market? What's the bond market telling us?
Bond market right back pretty much to the, as I say, the top end of what we've seen in the last 6 months or so. My work is showing that we're getting into a decent overbought territory right now, but it's got the capability of continuing to move higher after it has a bit of a pause. I think once again this is sort of the flight to security. Even if the yields are low, it's perceived that the bonds do provide at least a backing by, and in this case we're talking about government bonds, by an entity that has fairly good backing. I wouldn't be surprised that this run in the bonds maybe tacks on another 4 or 5 points here by the time it's finished.
Word out of the Congressional Budget Office in the U.S. Saying that any fiscal tightening could put the economy back into recession, boost unemployment. That would be good for bond prices, right?
It would be, and I would be, I'd be surprised that they will do anything that will have too much of a impact as far as the economy is concerned in terms of slowing it down. I mean, they know they got to be very careful here.
Okay, when the rubber hits the road, me as a retail investor here, how do I position myself in bonds? What should I do if I'm looking to get into some area of the bond market? Okay,
well, there are a number of ETFs that are available out there, and you could take a look both on the Canadian and U.S. market. You've got ETFs, and this is the best way for an individual investor to participate. There are ETFs that are involved with the corporate market as well as the government markets, and I think that's what people could take a look at. The XBB in Canada is the Universal Bond Index. That is a decent way to participate in that side of things. And you could also take a look at the corporates. The XCB would be a decent way there. So you're getting some return, and you're getting also the potential for some capital appreciation if they do go up in price. I wouldn't, from my technical perspective, I would recommend that people, if they do participate here, that they not risk any more than the lows that we had in October. There was a bit of a pullback in the bond market during October. That, I think, is the key support area for now.
Anything on the horizon that could tilt bond prices the other way, Ross?
Well, I mean, it's if you can see inflation right around the corner, and I don't see that one right now. But the bond market tends to turn from sort of spike type of highs, and I don't see that in the makings right now.
We are talking to Ross Clark with CIBC Wood Gundy in Vancouver here on This Week in Money. And let's talk about second component we've been talking about, the U.S. dollar, the dollar index over 81 today. Obviously, a lot of folks aiming for that safe haven, and the euro falling to a 2-month low. Give us a idea of what's going on in currency markets.
Well, as far as the euro is concerned, I've bearish on euros, bullish on the U.S. dollar. I think that's still a good longer-term play. And if anything, it should get a little carried away here. And in terms of the euro versus the dollar, I think that the euro is just in sort of a methodical downtrend here, had a decent bounce into September, but there's quite a bit of room to go. We're still looking to have it take out the July lows. I don't see any reason to be enthusiastic about the euro at this point, and the dollar index will continue for now, at least, to be deemed to be a safer haven. Let's look for, say, that dollar index to move up from 81 up to the 82 to 83 range, and up to where it was last spring.
Now, obviously, the U.S. dollar, the king of the hill. Despite all this fiscal cliff talk, it is probably the lesser of all the evils out there. What about the Canadian dollar? How's it been reacting to what's going on?
The Canadian dollar performs along with the commodities and with what we see happening in terms of the U.S. equity market. There's a pretty strong relationship. When you do the overlay of a Commodity Research Bureau chart with the Canadian dollar, and an even stronger one if you overlay the NASDAQ with the Canadian dollar. And so what we've had here is that mid-September high in the Canadian dollar easing back down. It's actually been fairly resilient this week in comparison to what we've seen in most of the markets versus the U.S. dollar. I would suspect that with continued strength, as I see it in the U.S. dollar, that the Canadian might get down around the 98-cent level in the near term.
Ross Clark with CIBC Wood Gundy in Vancouver, our guest. We're talking about basically what's been going on in the markets with gold, with bonds, and the dollar. Let's talk about gold. Gold and the dollar up at the same time. That's unusual. What's causing that? It
is. It's a safe flight to safety, and the perception that we will have more of the same as far as QE is concerned. As somebody said to me, it's QE infinity at this point right now. So that means that from a hard asset point of view, that gold and silver should theoretically do well over time, and that's the premise I work with. That everyone should have some core assets in bullion, put them away in a safe place, and don't worry about the day-to-day action. The shorter-term swings have been affected quite a bit by sentiment in the market. We take a look, I think, in our podcasts here in the last couple of months. We talked about how big the open interest was in terms of the speculative positions that had been established. The long positions by the small speculators were at record highs when gold was up in that 1790 bracket about a month and a half ago. The break that we've had in prices from 1790 down to the 1675 did a good job of cleaning out that open interest, so that in my analysis, I look at it and say that's good, because what it does is it takes a number of people, puts them on the sidelines who are now potential buyers once again, once the market starts to reassert itself. And so we've had this good clean out as far as the open interest is concerned, small specs coming out, the commercials were able to cover a lot of their short positions, and then with the action we've seen this week, pretty important. We had a $40 break in gold 6-7 trading days ago when it broke down through the $1,700 level. And it left some upside resistance levels that are just above us in the 17.25 to 17.30 range. And it's the break that happened created what I call an isolated low, broken down from that 17.30 level, took out an immediate support that was underneath us, traded to the 16.75, and has now reversed back so that it's trading in the 17.30 area. That type of a pattern where you take out a support and very quickly reverse back above it, we call an isolated low. And when that happens, it clearly shows that you've made a significant reversal in that you're able to move back through your previous resistance. There were very few sellers left at the bottom end, and so this thing is ready to turn. Now, when I look at the dollar index and gold coupled together and the fact that they were both strong at the same time, this is what we saw just in January of this same year.
Okay.
Where we had a support level, took it out, turned on a dime, and moved up with the dollar at the same time. It's what happened coming out of the low in June of 2011, just before gold had that great summer rally up to $1,900. So the pattern here is very good, I think, very supportive to gold. And I can see that there have been 5 of these type of instances in the last 2 years. 3 of the 5 managed to have very, very small pullbacks. It would be the equivalent right now of getting back maybe to 17.15. That was maybe a $10 or $15 pullback off the high.
Okay.
Before progressing higher. So my analysis here would suggest that if gold is capable of holding the early part of next week, the easiest path will continue to be to the upside.
Why does gold seem to keep bumping up against resistance at 1,800? It's been doing that all year long, hasn't it?
Well, we're in a broad trading range. I mean, it's not so much even that there was just resistance at the 1,800. There is just support also down at the 1,550 to 1,600 level. If anything, you want to take a step back and look at where we've come from in the last, 4 or 5 years here. It's been an exceptionally large run, and it's normal for a market to go through a consolidation phase or correct one of those big runs. So you do it in one of 2 ways. You either have, a full pullback, a deep pullback, or you go through a congestion consolidation phase like we've been doing for the last 13 or 14 months here. And the markets that give back very little ground during those consolidations are showing that they've got just tremendous underlying support. And in this case, I think it's really good support in the physical market. You get a lot of gyrations in terms of futures, and that's what we look at when we're looking at things like the commitment of traders for the small specs and the commercial interest, et cetera. But there is good, solid support underneath as far as the spot bullion market is concerned.
Ross Clark, our guest here on This Week in Money, and as always, we try to look after the interest of the retail investor. And would I be smarter to be involved in bullion, or should I stick to the ETF route for the next little while?
Well, I think you want to have a mix. You want to have some bullion. As I say, that's probably the core position that should be out there. But in terms of getting some leverage into this marketplace, owning stocks in the producing companies is a way to get leverage. Typically, you will get 2 to 3 times the market action in the securities than you will in the underlying bullion. And at this point, we look at we look at this bull market that started in 2000. The mining stocks like the Huey, which is the basket of basically unhedged gold mining producers, it has outperformed the S&P right up from 2000 right up until 2 years ago, December of 2010. Underperformed badly into the spring of last year. It's about 18 months of underperformance, and we're starting to see since May that the mining indices are once again outpacing the general market, and they are outpacing bullion. So there's the opportunity, I think, for people to take advantage of that move by being in, like in Canada, you would do the XGD, in the U.S., the GDX as broad-based indices. And I put together a table last weekend where I was looking at what I called good, better, and best stocks within the sector in terms of how they had held during that pullback that we had in gold, that $140 pullback from 1790 down to 1670, and took a look at the ones that had given back maybe 38% to 40% of the gains from the May lows, and were once again going back to retest the highs. Other ones that had given back maybe 40 or 50% and were looking stable. And so I ranked these, and there's a lot of good name companies in there, not too many for people to be overwhelmed with, and the ones that really sort of shine within this sector are the royalty companies. So these are the ones that get a royalty. They help in terms of the financing with mining companies, and in turn get a revenue stream back from them as they are selling off their metals.
Big difference from the pure exploration plays, right?
Oh yeah. The exploration side of the game, within the mining sector, within the precious metals, those stocks tend to be the ones that outperform in the latter part of the move. And what you like to see in the beginning part of the move is that the bigger cap names are doing well, because that's where the big institutional money is coming in. And so it's as it gets frothy, you get into the latter stages, and the juniors really come into their own. To me, that's a sign of concern when I see that, because it is to say it's the latter phase. It could be the last few weeks, it could be the last few months, but it's a red flag. And right now, I don't see that. What we see is that the leaders are they're the Royal Golds, they're the Franco Nevadas, the Silver Wheatons, these royalty companies, and that's nice to see.
What's the outlook going forward? Do you think mining equities are overpriced, or is there good value here?
Oh, I don't think they're overpriced. We've come from one of the greatest undervalued phases in the last 100 years, and there's I think still a lot to be done on as far as the upside is concerned now. And one of the problems, in regard, you have financing problems, etc. But from an operating perspective, as long as crude oil wants to stay down here under $90, I'm very happy, because where we've had trouble with these mining stocks in the last few years was any time that oil was up in the $100 plus level. Now it's down below 85. Yeah. When you've got 30 to 35% of your cost of production is energy, it really hurts the profit margins when you're up through the $100 level. But down here, this is quite a manageable level. Ross Clark with CIBC Wood Gundy in Vancouver. Ross, how do we get a copy of those charts? I'll have those available if you want to. People can send me an email at Ross Clark, that's ROSSCLARK, at shaw.ca, or you can give me a call in the office on Monday, which will be a working day. The number is 604-661-7759. Ross Clark, always good to talk. Thank you, sir. Thank you, Phil.
This Week in Money is archived online at talkdigitalnetwork.com.
Steve Forbes is chairman and editor-in-chief of Forbes Media. He is online at Forbes.com. Hey, Steve, welcome back to This Week in Money.
Good to be with you, Phil. Thank you.
Main focus this week, of course, the U.S. elections. You know a thing or two about the subject. You were a Republican candidate in the U.S. presidential elections, primaries, rather, in 1996 and 2000. Now, on Election Day in Forbes, you said Romney will win decisively. Didn't happen for a number of reasons, and I want to talk to you about those in a minute. But I want to ask you, what was it you liked about Mitt Romney? What didn't you like about President Obama and his policies?
Well, what I liked about Governor Romney was his pro-growth economic policies, particularly reforming the tax code, taking some of the clutter out, and reducing tax rates across the board. With President Obama, his policies, whether the binge spending, whether the devaluing of the dollar, continuous devaluing of the dollar, a desire to raise taxes, massive new regulations on the economy gave us the slowest recovery from a severe downturn in American history. So when a team doesn't perform, you get new manager. Mm-hmm. That's what I was hoping, but it didn't happen.
Okay, to your latest at Forbes.com, the 5 reasons why Romney lost, starting with one I hadn't considered, and that's the one, something you're experiencing right now, the Napoleon factor.
Well, Napoleon, when he was judging a general, one of his commanders, always looked for the seeming intangible of a commander who seemed to get lucky breaks. Some people, things seem to go their way more often than not. It's not something you learn in the textbook. It just seems to happen. And with President Obama, that's happened twice. In 2008, he was in a very close race with the Republican candidate John McCain. Then came the financial crisis in September, and that paved his way to a big election victory. This time, Sandy, the hurricane, a huge storm in the United States, allowed President Obama to appear commander-in-chief, crisis manager, and exit polls showed that helped him enormously, probably gave him a couple of million extra votes. And those things you can't plan for. They just happen. And he was a beneficiary of the Napoleon factor. Napoleon would have wanted Obama as a commander.
Now, the second reason Romney lost, the Chicago machine obviously dominated much of the process.
They did. They had a much better ground game, as we call it in the United States. When the president ran in 2008, then a senator, but became president, they did not shut down their campaign operation. They left a crew in all the major states, all the swing states. They beefed them up in 2012, but they never stopped. So they had a formidable ground game. They got their voters to the polls, persuaded, and that was critical. Tactics, but absolutely critical. Much better than what the Republicans did.
Steve Forbes, our guest here on This Week in Money. We're talking about the reasons Mitt Romney and the Republicans lost the recent U.S. election. And a classic mark in here, Romney basically allowed the Democrats to define him and the GOP.
That's basic in politics and many, many other parts of life. Despite our poor economy, the president dominated the agenda. And if you don't define yourself, if you don't define your agenda, define what you're running for, your opponents will do it for you. So the Republicans were always on defense on issues like waging war on women. It was nonsense, but it worked. One where they had more substance to it, illegal immigration. The Republicans handled that issue very, very poorly. So among Latino voters, Obama did better this time than he did in 2008. I think you're going to see a big change in the Republican Party on that issue. Even on General Motors, it was portrayed as Romney being in favor of liquidating General Motors and President Obama saving General Motors. What got lost in this was that President Obama put GM in bankruptcy. Yeah. It was just a matter of what was the better way to reorganize GM. And Romney had a better plan, which would have saved taxpayers $30 billion, reorganized GM. But it was portrayed, Obama portrayed it, as saving or liquidating. And Romney lost on that. On energy, the economy, same thing. And then the other big thing on that was that in terms of being defined, was that the Obama campaign ran $200 million of attack ads on Governor Romney from the spring till the early fall.
Wow.
And for several months, the Romney campaign didn't respond. And if you don't respond and fight those things, you get defined, and it's awfully hard to overcome it. You get to define your opponent, and the Romney campaign for several months allowed the Democrats to do just that.
Steve, an amazing amount of money spent by both sides in the election. The figure I heard was around $6 billion. Does that ring true to you?
I've heard anywhere from 2 to 7, so 6 is good as any. We don't know in this country.
Well, the Romney campaign, you say again here, basically failed because they didn't come up, despite all the opportunities, with much of substance.
Well, he had some good ideas. I mentioned the tax one. He had some other ones, but you have to lead with those. Ronald Reagan understood when he ran against Jimmy Carter 30 years ago, when the U.S. economy was in very deep trouble, that it was not just enough to criticize the incumbent. You have to have a positive alternative. Romney had it, but he didn't advocate it forcefully and consistently the way Reagan did 30 years ago. So it was almost sometimes came across as an afterthought. And you can't do that in U.S. politics. Americans don't like to fire presidents, even if there's trouble out there, as we have with our economy. But they will do it if they feel that the other candidate has a positive and credible program to deal with it. And Romney had one, but he didn't forcefully advocate it.
Easy for us to do a post-campaign post-mortem here, but could the Romney camp have done better by paying a little closer attention to the Reagan playbook?
Absolutely. And I think that's what people come away with. The candidate himself, a good man, a real record of achievement, had some good ideas, but how you use those tools are critical. And the Democrats used it better than the Republicans. And I thought Romney was still going to win, but turned out it was just a day late and a dollar short.
Steve Forbes, our guest on This Week in Money. President Obama in the news all week, of course. Today, he says he's willing to compromise on something we're all thinking about, the fiscal cliff. This is where if they don't come up with a solution, we might have a big problem as early as January. It did not take long for Wall Street to react. Investors clearly skeptical about any kind of a solution to the huge fiscal problems that America faces.
Well, the so-called fiscal cliff is a very real one, and it has worldwide implications. We have enormous tax increases that will come on January 1st, huge catastrophic cuts in our defense budget, and major increases on the middle class. All sorts of things come in. And only Washington could put all this stuff and time it so it goes off at once. So something has to be done. Ideas out there are, first, maybe postpone the bomb date or the cliff date for 3 or 4 months, so you have time to deal with it in a deliberate manner and not in a crisis atmosphere. I'm not sure they're going to be able to come up with an agreement short term, but what ideally would happen, and I'm not sure it will, but the ideal solution would be what happened in this country in the U.S. in 1986, when Democrats, at the time the U.S. tax code was full of tax shelters, which the Democrats didn't like. The Republicans wanted to cut tax rates, and so they cleaned the code out of tax shelters and cut the top income tax rate in this country from 50% to 28%, and everyone was happy and signed on to the deal. Now, today, an equivalent agreement would be, once again, to clean up the code in other areas and not raise tax rates, but reduce them, and still show that because these preferences, we call them, were cleaned out, so-called rich people will end up paying more. But the rates would be lower, which would be good for incentives for the economy, so everyone can plant the flag of victory. But I'm not sure that's going to happen, and the uncertainty is going to hurt our economy short term.
We're talking to Steve Forbes from Forbes Media on This Week in Money. A little bit of the substance, if you want to call it that, of what President Obama talked about today. He, obviously following Democratic Party policy, wants to raise taxes on wealthier Americans to help pay for those programs. House Speaker John Boehner says, nope, not going to happen. Tax hikes, the worst thing for the U.S. economy.
Boehner on that one is right. And that's why by taking away some of the deductions, the president could claim victory, that the rich don't have loopholes, so they are going to pay the rate that's stated there. Republicans can declare victory in the sense that the incentives needed to get the economy growing are not going to be removed or damaged. And this is very important because right now, most of the major countries in the world are all raising taxes and driving their economies into the ground. Spain has a high tax rate of 52% now, raising their value-added tax again. France is about to raise their top tax rate to 75%. Japan's been on a binge of tax raising. They just doubled their national sales tax, raised their top tax rate to 55%, raising their capital gains tax, and they're going into recession again. So we have to have the U.S. do something sane and show you can get these economies growing and not continue to drive them into the ground.
Steve, how is this for serendipity? Every time you log on to the Forbes.com website, you're greeted with a thought of the day. Today's thought of the day, I thought this made perfect sense with what's going on. It's from the late Frank Tiger. Wishes cost nothing unless you want them to come true.
So true. And that's another way of saying there's no free lunch.
Yeah, for sure. Steve Forbes from Forbes Media, our guest on This Week in Money. Steve's new book, Freedom Manifesto, Why Free Markets Are Moral and Big Government Isn't, is out now in hardcover. Also a Kindle edition. You're saying, Steve, we basically face a choice here between freedom and limited government or a socialist democracy where politicians and bureaucrats call the shots.
Yes, and I think that our own experience in the United States demonstrates that when you allow more freedom with sensible rules of the road, James Madison, who was the father of our Constitution, made the point, we are not angels, therefore we need laws and government. But having sensible rules versus overbearing ones and having the economy becoming more, having the government becoming more involved in the economy is a prescription for slow growth, if not stagnation. Mm-hmm. And up until the financial crisis, this country grew at an average rate, even though we're the largest developed economy in the world. We are growing at an average rate of about 3.5%, which is, for a developed economy, quite impressive.
One of the common themes this year, Steve, and you touch on this quite a bit in your book, the private sector has basically been the bad guy all year long. Greed, excess, corruption, we've seen lots of those headlines. And the government seems to be above all this. But you're saying, wait a second, government is anything but moral.
Well, when we emphasize this book that I co-authored, we emphasize this is about big government, not government with a small g.
Yeah.
We do need government, like this storms that we've had in the U.S., emergency measures. We do need government. But the size that it's becoming in the U.S. is, I think, at the tipping point and becoming very harmful. The thing about free markets, the reason they're moral, is you only succeed in a free market if you provide a product or service that somebody else wants. Even if you're lusting for money, you don't get it unless you provide something that somebody else wants. Voluntary transactions. And it brings about an environment where you pay attention to the needs of other people. You have to have teamwork to produce products and services. Breaks down barriers between people. You may not love a neighbor, but you sure want to do business with a neighbor. And so it's a positive thing, whereas big government looks after its own needs. And we saw a couple of graphic examples of it recently. One was in the Chicago school strike. Chicago has one of the worst school systems in the United States. But what was that dispute about? Simply about pay and benefits. Yeah. And the kids took the hindmost.
Great contrast here, chapter 2 of your book, FedEx or the post office. And you're saying free markets meet everybody's needs, but big government, they don't care. They just meet their own needs.
Absolutely. They use the rhetoric of morality, but government triumphs over, meets its own needs. You saw it in another chapter there. We have meritocracy versus cronyism. Meritocracy exemplified by Apple. Cronyism represented by Solyndra, where you get ahead because of your political connections, not because you're providing something that people really want.
Okay, so where do we go from here? If I could give you a magic wand that you could wave over the American political system, what would you do?
I think several just basic things. One is the U.S. has to stop trashing the value of the U.S. dollar. That's like changing the number of minutes in an hour. Doesn't get you anywhere at the end of the day. Very disruptive. Reforming the tax code, simplifying our tax code dramatically, so you get lower rates, which are very good for encouraging risk-taking and the like, and also removes a huge source of corruption, and allowing more free markets. and instead of having a government to become more and more intrusive.
Steve, the fiscal cliff, let's get back to it for just a second. And the discussion, of course, is ongoing. Are you predicting, as you were earlier, more can kicking? Are we just going to put it off until January, February?
There's one thing if you kick the can down the road with the idea that you're going to use the time to do something deliberate and constructive, and kicking the can down and just hope a miracle happens. I think now, with the aftermath of the elections, everyone realizes putting it off is not an option anymore. We got to do something. And so I hope they do so in an environment where you don't do something hastily and therefore have to clean the mess up later. So if they put this off for 3 or 4 months with the idea you're going to bargain and get something at the end of the day because there's a very real possibility to do it like we did in 1986, that would be a very positive thing.
Let me ask you a $64,000 question here, Steve. Do you think candidate Romney would have done a better job with the fiscal cliff than candidate Obama?
I think if Romney had won the election, I think we would have dealt with it very constructively and fairly quickly, because I think Democrats, there's a consensus emerging. We'll see if the White House recognizes this. But we have in this country, there was a commission called the Simpson-Bowles Commission, appointed by the president a couple of years ago to deal with our fiscal problems. And one of the ideas they came up with, the principal idea they came up with, was this, and that is what we just discussed, and that is to take some of the stuff out of the code, preferences, deductions, and reduce tax rates across the board. Democrats signed on to that idea, and the president ignored it, but Democrats were amenable to it, just as they were 25 years ago. So I think you can reach an agreement, which would be a very constructive agreement.
Steve Forbes, chairman and editor-in-chief of Forbes Media. He's online at Forbes.com. And you can also follow Steve on Twitter at Steve Forbes CEO. Don't forget the new book, Freedom Manifesto, out now in hardcover, and there's also a Kindle edition. Steve, thanks for talking to us today.
Appreciate it. Thank you.
Thanks to our guests, Ross Clark and Steve Forbes. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.